So as a financial advisor, I get questions on all types of investment products. I get questions on mutual funds, ETFs, stocks, bonds, but I'm telling you, one of the subjects I get questioned on probably the most is the subject of annuities. Now, I don't offer annuities in my practice. However, I did sell them for 20 years in a previous life, and so I do know what I'm talking about. So I thought what I'd do today is just kind of create a video, a 101 on annuities. What are they about? What are they? Who would buy this annuity? Who would not? That type of thing. So it's not covering all different types of annuities, but I just wanted to give you kind of a basics 101 on the subject, and just kind of go from there. So basically, what an annuity is, it's a contract that's issued by an insurance company. Okay, so an annuity is an insurance contract. It is insurance, and so usually insurance protects us against something. And so maybe it's volatility in the market, maybe it's living too long, things like that. But that's exactly what it is. So you can really divide annuities up into two big broad categories. One is called a deferred annuity. I don't want the money right now. I'm really putting it away and saving it for some future use. And the other category is it's an income annuity. And so, I want something that's going to provide me a paycheck, for a certain period of time, could be the rest of my life. And so, but that's what an income annuity is. So I'm going to start with the deferred category. So if you look at the deferred annuity category, we can really divide that up into two different types of annuities. One is fixed and one is called variable. Okay, so let's start with the fixed category. So if I was in the market for a deferred fixed annuity, it'd probably be for, hey, I want some safety in my portfolio. And so, I want like a guaranteed rate. And so it'd be kind of like buying a CD at the bank, only it's not FDIC insured. Annuities are definitely not FDIC insured. They're only as good as, the company that's providing the contract, as far as the safety goes. Insurance companies have different ratings as to how safe they are. There have been examples historically of insurance companies that go out of business. Doesn't mean necessarily you would lose money. It could be the contracts are acquired by another insurance company, but that's why those ratings exist, to tell you how safe this company is to do business with. So a deferred fixed annuity, let's say it's a 3% rate you're getting for a period of time. It could be a 3-year contract, could be a 5-year contract, 7 years, 10 years. There's all different variety of maturities. And so you kind of have to leave the money in there. And so because they're paying the salesperson that sold it to you a commission up front, you need to stay in that particular contract for a period of time. So if you try to break the contract early, you could encounter what's called a surrender charge, and those can be some pretty stiff penalties. Could be 5%, 7%. You really need to stick with the contract for that period of time. Some offer some liquidity. If I was to buy let's say a 5-year fixed annuity, oftentimes it'll have a provision where I could take out 10% of the contract value out every year without any kind of penalty. And so that could be handy. What if I bought a 3% contract, interest rates have gone up, and now that 3% is not looking that great? At least I could exercise my 10% withdrawal every year and maybe reinvest that at some higher rate. So that could be a case use for that. So somebody that would want to do that, you could use an IRA, you could use non-IRA. Annuities grow tax deferred, and so that's an added benefit. If I was to use non-IRA money, not only am I getting a fixed rate of interest, but it's also tax deferred. I'm not paying tax on that interest every year, but I do have a decision to make at the end of the contract with taxable money, or else I could be taxed on that once the contract expires and I withdraw the money. So that's a whole other subject. But you could use IRA money, you could use non-IRA money for a fixed deferred annuity. It's kind of like buying a CD without the FDIC insurance. So let's talk about the variable deferred. Okay, so maybe I am working, I have a 20-year time horizon. I've already done all the max stuff. I've maxed out my 401k plan. I've maxed out my IRA account. I got an emergency fund in place. Now I still want to put more money away. Okay, so that's where a deferred variable annuity could be the right solution. Okay, and so usually you can put unlimited amounts of money into it, and there's usually a list of mutual funds available, everything from conservative to aggressive, actively managed funds, index funds. There could be some single fund solutions like moderate, balanced, conservative, aggressive, all different stuff like that you can invest your money in. And so the advantage would be tax deferred growth And so if you're familiar with how mutual funds work, I mean, you kind of have to think of the origin of this. So back in the day, mutual funds were the primary investment vehicle for the average consumer. You open a brokerage account, you buy a great mutual fund, and they notoriously have these year-end capital gain distributions where you're taxed on this money every year, every December, as long as you're saving the money. So the pitch could be, hey, you can put the money into this deferred variable annuity. You can still buy a mutual fund. You're just in this tax deferred umbrella now, gross tax deferred. And I could make exchanges between funds. I'm not taxed on capital gains when I make those exchanges. So I think that's really the pitch behind it. I could put unlimited amounts of money into it, and it grows tax deferred. Now, to be fair, in this day and age, there's a lot more investment choices, index funds, ETFs, things that are very tax efficient that don't have those year-end capital gains. So, some people might question the value of putting it into this annuity contract when I can just invest in a brokerage account and things that are very tax efficient. So I see that argument too. So anyway, that's what fixed deferred annuities are and what variable deferred annuities are in a nutshell. Variable deferred annuities, by the way, have a variety of costs. Some can be very expensive. I've seen some variable deferred annuities that are 2-3% internal costs, and some are zero. I mean, it just depends. There's a wide range in expenses that eats into your returns. So if you have an expensive variable deferred annuity, boy, you really have to overcome quite a bit, just to make money in the contract for it to be worth it over a long period of time. Okay. So let's talk a little bit about income annuities. Now, income annuities you can divide up into the same two categories: fixed income annuities and variable income annuities. Now, think of like a pension. Not many people are fortunate enough to have a pension these days. That was really the previous generation. A lot more people had those. But so if I was looking at my retirement plan and I was worried about maybe outliving my assets, I have longevity in my family, I have a reasonable belief I'm going to live a very long time. I'm worried about running out of money at some point. You might be a candidate for a fixed income annuity. And so I think if you're, let's say you said, hey, I've got a great retirement set up. If I had an extra $1,000 a month, that would be that much better. So I would get a quote from the insurance company that'd say, this is how much it's going to cost and to provide that $1,000 a month for the rest of my life. So I went to one of the major carriers and just did a sample quote for hypothetical 65-year-old couple, husband and wife here, and it would cost about $186,000 to buy $1,000 a month for the rest of their joint lifetime. This particular quote I got is called a cash refund quote. So that just means that if either one of them are living, they're still going to get that $1,000 a month. If you live to be 120, the checks keep coming. If one person died prematurely, the check still comes to the surviving spouse. What cash refund means is that, let's say that both of us died prematurely, the both spouses, and we'd only collected, let's say, $100,000, cumulatively from this contract. Your beneficiaries would get the remaining portion that hasn't been paid out yet. So they'd get basically a lump sum of $86,000. So you have to at least get out of it what you put into it. So that's what a cash refund quote is. So could be an advantage. Again, it's only as good as the insurance company that's backing up the contract. That's a long time, a lifetime contract. You could also buy, an income annuity that's for a shorter period of time, maybe like say 10 years or 5 years, maybe if you only needed the income for a period of time. But, so the argument against that would be, hey, that money is now out of my control. And so, and by the way, the quote as to how much that costs to buy that contract, an insurance company hires, they're called actuaries, and they basically set that line, based on your age, where interest rates are, this is how much it's going to cost to buy that amount of income. And so that can change. The higher rates are, the less money it requires to provide that income. The lower rates are, it requires a lot more capital to provide that income for life. So just keep that in mind. So on the variable income side, some people might be comfortable with the ups and downs of the stock market. And so the same principle, I buy $1,000 income for the rest of my life, And that's going to fluctuate based on the investment experience of the portfolio. Maybe there's some mutual funds I have to choose from, and my income is going to be based on the ups and downs of those mutual funds. So not everybody wants it. Most people I know want dependable income. Although you could argue, hey, that's going to keep up with inflation better over time than just a fixed income annuity. If you have a fixed income annuity, maybe $1,000 a month was great now, but let's talk 20 years from now. Inflation's a factor. How's that working out now? I mean, the $1,000 ain't what it used to be. Whereas a variable income stream, hopefully will keep up with inflation as the stock market increases or decreases over time. 15, 20 years ago, the variable income annuities were pretty popular products because the stock market was just simply raging. You had internet stocks, tech stocks, just going through the roof, and some people at that time, bought variable income annuities where their income was tied to the stock market. And so I think after the tech bubble burst in 2000, I had another financial crisis in 2008. I've seen a lot of carriers kind of discontinue offering those variable income products just because people lost so much of their income because the tech stocks crashed or whatever, and with it went a lot of their income. So, buyer beware. I think that you just have to be really careful when you're evaluating a product like that. I don't have any particular thoughts on which is appropriate. It depends on every person's individual situation. Annuities can be a very complicated subject. A popular phrase these days is explain it to me like I'm 5. If you can't sit down with somebody and explain to them why I purchased this annuity contract, what the costs are, and what's the benefit to me, don't do it, in my opinion. You need to be able to understand the complexities of the product and what it's going to do for you and what the costs are. It's never, I don't think it's appropriate if you can't understand it to sign up for something like that. So what I would ask anybody, and this is kind of consistent in all the videos I do, is work with somebody that knows what the heck they're talking about. You don't want to work with somebody that just passed their insurance license and got out the phone book and started with A, and hey, they finally got around to you. You don't want to work with somebody like that. Work with somebody that is very knowledgeable, can look at the entirety of your situation and maybe say, hey, here's an opportunity for this product or that product. But you don't want to work with a kind of a financial salesperson, in my opinion. If you're working with somebody and they're continuously following up with you and they seem to always be focused on talking about this one product, that might be a red flag. You might want to say, hey, this just kind of walk away from the conversation, and maybe that's not for me. And so, kind of give it a cooling off period. Once you buy an annuity, you're kind of stuck with it, for whatever the contract states, you're stuck with it. Now, of course, they're stuck paying you in the case of an income annuity, or maybe it's a fixed deferred annuity. They're stuck paying you that guaranteed rate. So the stuck works both ways. Anyway, I just wanted to create this Annuities 101 video today. I hope you found it helpful. If you have any questions, my contact information is in the About section of my YouTube channel. And thanks for watching my video.